The speculative frenzy gripping markets today, driven by technology and unprecedented liquidity, is not a unique phenomenon. Rather, it is a modern echo of the Gilded Age speculation that peaked around 1900. While the assets themselves have transformed from tangible steel mills to intangible software platforms, the core psychological drivers of greed, leverage, and the belief in permanent prosperity remain strikingly identical across the centuries. We are witnessing a clear parallel where periods of massive economic transformation inevitably breed irrational exuberance, convincing investors that established rules of valuation no longer apply. This deep dive compares the industrial trusts of the early 20th century with the digital giants and decentralized assets dominating the 21st, revealing how history's rhythm of boom and bust persists. Before we dive into the mechanics of these two great speculative eras, please take a moment to subscribe to the channel and leave a quick comment below. Even a single word can greatly assist the algorithm in recommending this analysis to a wider audience, confirming that this detailed content is valuable and worth the significant effort required to create it. Furthermore, I urge you to return to this channel during challenging times, especially when market volatility makes trading difficult and your confidence begins to waver. Your simple actions now ensure that resources and perspective are available when they are most needed. So please click subscribe now. The economic stage for the 1900 boom was set by the end of a long depression, fueling massive industrial consolidation driven by monopolistic ambition. Similarly, the current speculative wave was ignited by the legacy of zero interest rate policies and the massive liquidity surge following the post-pandemic recovery. Both periods share the common foundation of abundant capital seeking rapid deployment and the widespread acceptance of risk in the pursuit of exponential returns. These environments cultivate the dangerous illusion that fundamental economic laws have been suspended, leading market participants to chase ever-increasing valuations. The comparison begins with the underlying assets that fueled the mania, contrasting the physical infrastructure of the past with the digital networks of the present. In 1900, speculation centered squarely on tangible trusts and monopolies, assets that represented physical infrastructure and controlled essential services. The key players were railroads, massive steel complexes, and the consolidated power of Standard Oil, all promising guaranteed cash flow through monopolistic dominance. Investors were betting on the physical control of production and distribution, convinced that these giant corporations possessed limitless pricing power. A defining moment was the formation of the U.S. Steel Corporation in 1901, capitalized at an unprecedented $1.4 billion, an astronomical sum for the time. This massive valuation demonstrated the era's profound belief in the limitless value derived from consolidated industrial power and vertical integration. However, this capitalization often relied on the deceitful practice known as watered stock, where assets were optimistically or fraudulently overvalued. This process inflated the market capitalization far beyond the actual book value or productive capacity of the underlying physical assets. Today, the assets of mania are fundamentally different, focusing on intangible intellectual property and network effects. The capital chase is concentrated in technology platforms, specifically software as a service models, burgeoning artificial intelligence firms, and highly volatile decentralized finance assets like cryptocurrency. These entities derive their value not from physical infrastructure, but from future growth potential and the total addressable market they aim to capture. The massive market capitalization of today's tech leaders is primarily based on projections of future disruption and exponential user adoption. Unlike the trusts of 1900, many modern speculative favorites often lack current profitability, justifying their price based purely on the expectation of eventual monopolistic scale in a digital realm. Furthermore, the recent boom saw a heavy reliance on alternative listing mechanisms, such as special purpose acquisition companies, or SPACs. These vehicles were specifically designed to bypass the rigorous traditional scrutiny required for initial public offerings, allowing highly speculative or early-stage companies to access public capital quickly and easily. This method mirrors the lack of fundamental transparency that characterized the overvaluation of the industrial trusts a century ago. The methods used to inflate these bubbles reveal a deep contrast between insider control and modern systemic liquidity. In 1900, the market was defined by insider control and a profound lack of regulatory oversight, granting immense power to financial titans. Banking syndicates and figures like J.P. Morgan could manipulate markets through pooling agreements, effectively controlling the supply and demand of specific stocks. They also held sway over the flow of credit, operating entirely outside the structure of a central bank, which did not yet exist. This fragility was brutally exposed by the Northern Pacific Corner in 1901, a rivalry between powerful financiers that nearly triggered a systemic collapse across the entire market. The uncontrolled use of short selling and excessive leverage led to a devastating scramble for shares, demonstrating how the actions of a few individuals could destabilize the entire financial system. The absolute absence of effective oversight bodies meant that there were no checks or balances to prevent these intentional manipulations. The Securities and Exchange Commission, the essential watchdog of today, was still decades away from being established. The current environment, however, is shaped by democratization and overwhelming systemic liquidity rather than insider control. The primary mechanism driving risk assets has been unprecedented global monetary easing, known as quantitative easing, which injected massive amounts of capital into the financial system. This deluge of liquidity sought returns everywhere, driving capital into risk assets regardless of their fundamental value or underlying profitability. The sheer volume of money distorted traditional price discovery mechanisms. Modern market structure is further complicated by high-frequency trading and complex algorithmic strategies, which accelerate short-term volatility and intensify market momentum. These technologies can rapidly amplify price movements, turning minor corrections into cascades, a level of speed unimaginable in 1900. Crucially, the accessibility factor has changed everything, with commission-free trading and gamified retail platforms lowering the barrier to entry to zero. This accessibility has allowed unprecedented participation from retail investors, creating a market structure defined by mass momentum rather than elite control. Examining the rhetoric used to justify these extraordinary valuations highlights the timeless tendency to rationalize the unjustifiable. In the Gilded Age, the prevailing justification was that the industrial trusts represented inevitable monopolistic dominance, a permanent structure guaranteeing endless profit growth. This rhetoric convinced investors that the colossal size of companies like U.S. Steel protected them from competition and assured perpetual returns. Extreme valuations were justified based on the perceived future monopolistic pricing power, treating these companies as near-sovereign entities. The valuation metric of choice often focused heavily on dividends and the potential for asset stripping, largely ignoring the complex underlying debt structures hidden beneath the layers of industrial consolidation. Financial reporting was opaque and often intentionally misleading, making true fundamental analysis nearly impossible for the average investor. The belief was widespread that these trusts were too big to fail, and that their established grip on essential resources guaranteed safety, regardless of the price paid for the stock. This certainty of permanent profit blinded many to the underlying risks of market saturation and cyclical downturns. Today's justification hinges on the concept of disruption and exponential growth, arguing that technology companies operate outside traditional economic constraints. The language revolves around network effects and the winner-takes-all dynamic, suggesting that once a tech platform achieves critical mass, its growth becomes unstoppable and its dominance unchallengeable. This narrative allows companies to justify valuations based on astronomical price-to-sales ratios, even if they have negative cash flow or zero current earnings. The focus shifts entirely from present performance to abstract future potential. There is also a strong behavioral component centered on the billionaire founder narrative, where immense faith is placed in visionary leadership to perpetually disrupt existing industries. This reverence for the charismatic tech leader directly mirrors the worship of the captains of industry like Andrew Carnegie and John D. Rockefeller in 1900. Both eras exhibit a collective willingness to suspend disbelief, equating the founder's genius with guaranteed unending financial success, regardless of current financial metrics. The belief that this time is different is simply repackaged as this technology is different. The fate of the retail trader provides the most poignant and enduring parallel between the Gilded Age and the Digital Age speculative waves. The 1900 boom saw the widespread entry of the small, often unsophisticated investor into the stock market for the first time, lured by seductive promises of quick wealth tied to America's explosive industrial expansion. These individuals were often farmers, small business owners, or clerks convinced that they could secure their future by owning a piece of the great trusts. They poured their limited savings into stocks, driven by the intense societal momentum of the Gilded Age. However, these unsophisticated traders were typically the last to enter the market, buying at the peak of the mania when valuations were already stretched thin. They were the most vulnerable to the sudden collapses and intentional manipulations orchestrated by the powerful financial syndicates. Facing ruin due to high leverage and a profound lack of internal information, they were often wiped out when market titans decided to adjust prices or call in loans. The era was characterized by a fundamental information asymmetry that heavily favored the powerful insiders. Today's experience involves mass participation driven by coordination through social media and decentralized forums, exemplified by the phenomenon of meme stocks. Retail traders now coordinate their efforts, attempting to collectively challenge institutional short sellers, using momentum and sheer volume as their weapons. The accessibility of modern trading has led to the widespread use of highly leveraged derivatives, particularly complex options trading, by retail traders aiming to amplify their returns. This practice results in extremely rapid cycles of both wealth creation and devastating destruction. While the medium of communication has shifted from whispered tips in brokerage houses to instant messages on online forums, the core behavioral detail remains the same. Both eras show the small investor entering the market with limited fundamental analysis, often ignoring traditional valuation metrics entirely. Their decisions are driven primarily by momentum, social proof, and the overpowering fear of missing out on life-changing wealth, a psychological constant across all speculative cycles. The democratization of trading has not eliminated the risk. It has merely distributed the ability to take on catastrophic leverage more widely. In synthesizing these findings, it becomes clear that history does not repeat itself in exact detail, but the underlying speculative cycle and the core human behavior are identical. The assets have certainly changed. We moved from railroads and steel to data and algorithms, but the fundamental drivers of greed, irrational exuberance, and the misuse of leverage are timeless. Every generation develops its own unique narrative to justify why its particular assets deserve valuations that defy economic gravity. The 1900 speculative period, driven by the consolidation of industrial power, eventually led directly to severe market corrections and intense public demand for regulatory reform. The volatility and widespread ruin experienced by small investors eventually forced the creation of government oversight bodies designed to curb the excesses of financial titans. Today's environment, characterized by massive systemic liquidity and concentrated capital in volatile technology sectors, carries similar, perhaps even greater systemic risks. The interconnectedness of global finance means that a collapse in one highly leveraged sector could quickly propagate worldwide. Therefore, the final answer to whether history is repeating itself is a definitive affirmation of the cyclical nature of human psychology and finance. The structure of the mania is new, leveraging digital tools and global networks, but the psychology of the market remains perfectly timeless. We are witnessing the same pattern of exuberant overvaluation, followed by inevitable painful correction, proving the core claim. The wild speculation of 1900 is being mirrored today, merely cloaked in the sophisticated language of disruption and artificial intelligence. The names on the ticker tape change, but the lessons of market history remain stubbornly consistent. If you are interested in delving deeper into the history of these monumental financial shifts and the characters who orchestrated them, we highly recommend the foundational work, 50 Years in Wall Street. This comprehensive 2-volume memoir by Henry Clews provides an unparalleled illustrated account of half a century of Wall Street history. spanning from the panic of 1857 right through the heart of the Gilded Age. The book offers unique first-hand narratives of the financial titans, detailed explanations of the market manipulations prevalent at the time, and essential insider perspectives on key events that shaped modern finance. Understanding the mechanisms of manipulation during that era is essential for recognizing similar patterns today, so secure your copy of 50 Years in Wall Street through the link provided in the description below. The greatest defense against speculative mania is not regulation but knowledge, allowing the investor to recognize the timeless pattern of irrational behavior. By studying the parallels between the industrial titans of the past and the digital disruptors of the present, we equip ourselves to navigate the inevitable volatility ahead. Remember that financial crises are not random events. They are the predictable result of collective human behavior, amplified by leverage and justified by the belief that this time truly is different.